So, what is the prognosis for Indian markets and why are the underlying trends so weak? And what can change that as we go into 2025? I reached out and spoke to G Chokkalingam, founder of Equinomics Research, and I began by asking him what were the broad and early trends that he was seeing going into 2025 and what could influence markets in coming weeks and months.
The fall has started in September 24 and it continued till the end of last year, 24. And fortunately, the small and mid cap indices outperformed Sensex and Nifty that period. But that got reversed in the first 10 days of January now. The small cap is falling more than the Sensex. And in the process, from the peak of September 2024, nearly 54 lakh crore rupees, 54 trillion rupees of market cap got wiped out from the market. And, while mid and small cap account for 55% of this wipeout, large cap accounts for the balance. Now, what are the reasons for this latest trend? The GDP growth slowdown, as we all know, for FY25. But the latest news of, GDP growth being around 6.6% for FY26 also hit us, this week. That was a big surprise because a lot of people thought FY26, India could improve the growth above 7%. So, like United Nations has come out with a forecast of 6.6 even for FY26. And then the old news is that the Fed may not jump in cutting down the rate. And third most important, which is unique to Indian market, is the liquidity. In last calendar year, foreign portfolio investors have sold about 1.21 trillion rupees worth of shares in the secondary market. But they invested 1.22 trillion rupees in primary market through IPOs and also through QIPs. So what has happened? That has taken away the liquidity from the markets. And we also know that last calendar year, the promoter selling was one of the highest in the recent years. So these IPOs, promoter selling through QIP, the money got chucked out of the secondary market. It all gone to promoters largely in the secondary market through secondary market selling and also through IPO. Even the FPIs, they swap their money for a primary market with money proceeds they generated from selling in the secondary market. All of us know that, generally the stocks listed on the secondary markets were, not so overvalued as compared to the primary issues in 24. So these FPIs, they swapped, this money by selling in secondary and buying in primary. So now that also led to a lot of pressure on listed space in the secondary market. That also led to the draining out of the liquidity from the hands of the investors. Because normally in secondary market, if it circulates, some set of stocks are sold, some set of stocks are bought. But here it was one way direction. Then the fourth one is weakness in the rupee and foreign exchange reserves. So historically, when the local currencies start depreciating, the trend continues. The FIs sit on the sideline. They don't invest aggressively because they will directly lose money and the local currency depreciates. So normally, when the short-term trend is down, they sit on the sideline. They don't invest. Rather, they even start booking profit. That's what exactly happening now. And one more interesting historical insight is that particularly when the market becomes weak and there is a budget forthcoming, many foreign investors, they wait for the fine print of the budget before they make the next big move. So all this led to weakness in the secondary market, a lot of selling happening. Added to that, the expectation of earning growth. Generally, it is a single digit for all aggregate corporate world. This is what led to these weakness. So unfortunately, this may continue till end of this month, till the budget is presented.
Right. And I'll come to how things look beyond that. So the net outflow that we are seeing right now, for example, in Jan is about $2 billion for FIIs. So how does that compute with in the context of IPOs? You're saying people, if they're selling in the secondary market and moving to primary market, the money is still within the system, but the net outflow is still higher, right?
Yeah. That's what happened in 24. In Jan, first week, that argument is not that valid because it's only just 10 days and not many IPOs have come. Now, what happens, when they sell in a secondary market, the market participant in the secondary market, that liquidity gets chucked out. Now, when they reinvest in the primary market, and unfortunately, what has happened, a majority of the fund flow mobilized through IPOs, they have gone to promoters directly. What I mean to say, both of us know The economic development calls for very strong primary market. That is true. But this year in 24, a lot of offer for sale happened. Offer for sale, which leads to mobilizing money from the primary market and which goes to the promoters for unlocking. That was a very dominant. So therefore, to that extent, the liquidity gets stuck in the hands of promoters. So it is not circulating in the hands of investors, nor it is going to add to new capex also. So that was unfortunate fact. So a lot of money went for unlocking rather than reinvesting in the capex or reinvesting in the secondary market.
Right. So on the supply side, inflows into mutual funds continue. And there is obviously a lot of liquidity with mutual funds as SIPs are still systematic investment plans from small investors are still looking steady, if not strong. So that does not seem to be offsetting all of this.
Yeah, very interesting question. And interesting data point is that precisely the reason you have said that's what helped small cap to outperform Sensex and Nifty by big margin from September peak to December 31st. Small cap index fell least among all Sensex, Nifty, and the BSE mid cap indices. So most of these retail investors, they tend to buy small cap because they take a lot of risk and they want to make quick wealth or a long term wealth. Now, this 10 days experience is a little odd. Despite huge fund flow through mutual fund by the retail investors, especially in this first 10 days, the fall in small cap is more. However, I have a view that ultimately in this quarter itself, once again, small and mid cap would outperform Sensex and Nifty for 2-3 reasons. Till last Saturday, in a matter of just 3 weeks, around 27 lakh new investors still entered the market despite market weakness. So on the one hand, a lot of money is flowing from the retail investors to mutual fund. On the other hand, a lot of investors are getting participated in the market. Third, the reason which will help us to see this outperformance is that, in the large cap, you have sectors like cement, IT, FMCG, so many, auto. Many of these sectors, what I call as single digit growth syndrome. IT exports in dollar term is in a single digit, FMCG volume growth in single digit, cement also in a single digit volume. So they continue to suffer from the single digit growth syndrome. Whereas there are around 4,000 stocks in the small cap space. There's still a lot of individual growth stories, value unlocking stories, deep values in terms of land bank, in terms of investments by holding companies and acquisition possibilities. Like for example, in cement, we saw 2 acquisitions in the short span. So that, and plus the investors are still coming at the rate of 7 lakh per week, and they're also investing in small cap funds of mutual funds. So therefore, I believe today's shock would be temporary. In Jan-March quarter, once again, the retail investors would support in a big way, significant way, the small cap and mid cap stocks. Therefore, I consider that bank on the domestic market, bank on the domestic businesses, bank on the domestic investors, which obviously means bank on the small and mid cap segment for next 3 to 6 months. That would be relatively better avenue to invest.
Right. And within that, this quarter at least, are you seeing any sectors which to you look more attractive than as opposed to other sectors which you feel are more on the sunset side?
One would be pharma. IT is a defensive, but we saw the initial result also only 3-4% growth. So one could be the pharma. It is defensive. It will be benefited by the rupee depreciation, and the pharma would also see some acquisition they saw in the recent period. Even small cap ITs would see some consolidation. In the last 10 years, it happened, but last 1.5 years, there is a lullness in the space of acquisition because the whole industry is growing at 2-3%. So that possibility is there. So small cap IT stocks and the small cap quality pharma stock, these are the 2 areas. And then there are a lot of holding companies. There are cement companies. If you see the 3 acquisitions in the last 6 months in cement space, they happened at $80 to one at $80 per ton, other one at $112, other one at $118 per ton. So there are many quality cement companies, few companies which are available at enterprise value per ton of $40 to $50, but with a good business model. So that is another area in a small and mid-cap space one can look at.
Right. Chokka, thank you so much for joining me.